An understanding of the capital stack, and we're going to spend some time on this. I have another slide with more details, but first I want to introduce what does a capital stack look like between the money you need to purchase an asset, the budget for renovations, and any closing costs. Those are going to be how you're going to use the capital, but the source of the capital or the capital stack is going to look like what we have here on the screen. And typically you would have equity, or sometimes called common equity, on one side, and the senior debt. Sometimes, on depending on the deal and depending several factors, you may have preferred equity, and we're going to discuss that a little more on the next slide. This particular chart illustrates as well mezzanine debt. It is pretty unusual on in-place multifamily acquisitions. It's more common in the context of new construction. So if we dig a little bit deeper, and I have actually several levels of how deep we go on that topic here. But let's start with the senior debt. And why we start with that, because it's going to represent between 50 and 85% of the whole stack. The interest rate is going to vary between 3 and 8%. And we're going to talk a little bit more about interest rates in the coming slides as well. But senior debt is going to be the primary mortgage on the property. Mezzanine is a level above, meaning that they're going to be paid after the senior debt. So that's why it's called also a secondary loan. And it may represent, that's why I put 0, because again, in the context of multifamily, in-place multifamily, it will be most likely 0, could be up to 20% of the stack. And they're going to have higher interest rates. And if you notice that, the higher you'll be on the stack and the higher the returns are going to be, right? So returns, interest rate is going to be interchangeable in that context. So the preferred equity, so now we switch to the equity side, meaning that anybody with a loan or mortgage on the property, is going to be recorded. They will have a lien against the property. So those debts, they will be directly backed by the asset itself. But when you go on the equity side, the equity is going to own a share in a company that owns the property. And the terms of the debt is going to say, look, we're going to be paid first in any case. So the senior debt, potentially mezzanine debt, and after the equity will be paid, right? So that's the difference. From at least let's say the capital stack standpoint, that's the difference between the equity and the debt. There are other nuances. We'll stick to the capital aspects. So preferred equity, again, it's a level above, and preferred means that they're going to be, from an equity standpoint, they will be paid before the common equity, right? So they have certain benefits of the ownership, right? But they are above basic ownership, which is the common equity, right? So they're going to look for returns between 10 and 16%, and it could be part of that is going to be due like during the hold period, and there will be a catch up at the end. So that's typically when the way it's going to be set up. It's interesting. I think it's an interesting tool to use because you may obtain more leverage. However, you have to use it being aware of the implications for your common equity, for the general population of investors. They're going to be paid after preferred equity. And that's the big difference. I think from that standpoint, from the total equity, if there is 20, 30%, that is in a preferred equity, meaning, again, being paid first, it's acceptable. Anything above that, as an investor, I don't like to see that, because then the risk is if something goes wrong, first senior debt is paid, then mezzanine debt, then preferred equity, and then what is left for common equity if something goes wrong. So that's the idea there. Hopefully that's clear. So I have a little bit more information, but it's basically what I explained. Senior debt, no gains from appreciation. Could be fixed or variable interest rates payments. We'll talk about that later as well. It's collateralized by the property. First to receive payment, the lower risk, right? Lower risk, lower reward. And as you go up, higher risk, higher reward. So it's the same thing, mezzanine debt, higher returns than senior debt, secured by ownership. Yeah, shares of the property. I think it's more, it's collateralized by the property. I'm not sure about this actually. But repaid after the senior debt, medium risk, higher risk for pref equity. Receive payments before common equity, but less upside than common equity. And common equity last to be repaid, higher risk. And that's a big difference here. There's a basic ownership interest in with potential tax benefits, and cash flow from distributions and higher upside potential. So we're looking at returns could be at 15, 16% plus type of annual returns, typically more weighted towards the end, the disposition of the deal. And the common equity can represent 10 to 40%. And it's a pretty, I'll open the floor if there's any question on this. I think the other ones are much more simple. And if there are no questions, I will carry on. So let's talk about, again, if I come back to this, what's important, senior debt, common equity, and now we're going to spend a lot of time on what senior debt is, where you can get that. So senior debt options. The first one is commercial mortgages that will be provided by either a regional national bank or a credit union, or also specialized commercial lenders. But say typically regional banks and credit unions are interesting. We're going to go a little bit deeper about some of the nuances in the next slides, but all the lenders, they're going to require a down payment 20 to 30%. So there's no difference there with the rest pretty much. There will be fixed rate or adjustable rate options. Absolutely. Sometimes interesting. I think the big difference is these going to a bank, most likely that it will be a recourse debt, meaning that any people signing on the loan, they will be responsible to pay it back. It's not only backed by the asset, it's also backed by the loan, people signing the loan on the general partnership side. The next option, very common, the semi-state or federal agencies, Fannie Mae and Freddie Mac. So yeah, government-sponsored enterprises, I guess that's their formal name, who provide financing for multifamily. So they're really specialized. Usually in a typical environment, they have the better interest rates and terms compared to commercial loans or bridge loans. But in some cases, and that happened a few years back in 2020, 2021, particularly, bridge loans had better interest rates actually for a period of time. And at that point, there was a lot of operators who went into bridge loans, even if they didn't But yeah, one of the requirements is that they're going to look for stabilized property. The 90% occupancy, cash flowing, that's going to be the Fannie Mae and Freddie Mac direction there. So the third option is going to be a bridge loan. And basically, and it's useful for value add. I would say when we spoke about value add at Boost, we are more referring to a stable property where there's an opportunity to add value. In this context, the value add is really heavy value add, where it could be a distressed asset, low occupancy, like lower than 80%, for instance, or even lower, or very heavy renovations, expensive renovations that are planned. That's where the bridge loan is an interesting option because you'll be able to finance the capital expenses. I have another slide on the financing options. It's just, I think it's interesting to know that these options exist. It's the CMBS, commercial mortgage-backed securities. It's a little bit of a specialized product. It's unusual, but sometimes the lending brokers, they will mention that option. But it's like the big finance banks like Morgan Stanley and whatnot, they will offer this type of product. So yeah, pool of commercial mortgages bundled so that securities and provides liquidity for the lenders, may offer competitive rates. That's why it's a kind of more of an unusual product. Similarly, life insurance companies offer some products as well. But I think it's actually they may bundle their products into CMBS, not something necessarily readily available for, let's say, the typical deals that we do, but just something to be aware of. And finally, something that we hear more about, the HUD or FHA loan, the Department of Housing and Urban Development loans. Larger properties, favorable terms, usually it could be up to 35 years of amortization, but there are a lot of constraints and a lot of requirements on the management of the property because there's a lot of paperwork. Again, heard better terms potentially. Oh, and by the way, they take 6 months to close. But so it's a very paperwork intensive, limitations on distributions. If I have a whole list, but just again, so something, a product to be aware of.
USDA also has loans too, something to consider. The
I
US
believe.
Department of Agriculture.
Oh, yep. Yeah, that's right. That's right. Yeah. I think, yeah, it could have been.
So it depends on where the
Yeah, as well.
property
Yeah.
business is. It has to meet certain criteria, just like these other ones. So USDA loans are a thing for folks that are not aware of that.
All right. So shifting gear to more, I think, actionable things. Again, like the takeaway from the first slides, think about common equity, senior debt. From these last couple of slides, the most important to know is probably Fannie and Freddie, agency debt for stabilized properties, and bridge debt for heavy lift. So what do you need for loan sizing? The lender is going to require a rent roll, trailing 12 months of income and expenses of the property. So that's coming, both of those, they come from the seller side. And by the way, because sometimes I have students who are looking at deals, there's no paperwork, there's no trailing 12. So now it becomes a little more difficult to work on getting some kind of loan. Now that I'm thinking about it, I think an important option that I could have added in senior debt is going to be seller finance. And I think seller finance, it will work if the owner owns a very large piece. Basically, they paid off their debt, right? So it's not necessarily usual, but so if the owner has very little, it's an option in that case. All right. So again, rent roll trailing 12 from the seller. From you, they're going to expect what's your capex budget, capital expense to do the renovations, to the unit interiors, to the exterior. And they're also going to expect from you a pro forma of income and expenses going forward. And that's something we discussed in prior call about the underwriting, etc. process. So that's what they're going to ask of you. And now let's talk about a few important concepts, and some we spoke a lot about, but now that we enter in the debt world, there are some additional definitions to understand. But something that we discussed before, NOI, net operating income, is going to be the income of the property minus the expenses. The debt service is going to be the principal and interest on the property. Now, the cash flow is the next level, right? Because if you think about the debt service, that's something that the owner choose to have, to use leverage to buy the property. So in the definition of the net operating income being basically the rents and any additional fees, etc., expenses, they are only the expenses pertaining to the property, not to the debt. So if you want to take into account or let's say how the property really does on what kind of cash flow is generated, you have to take the NOI, so income minus expenses, but then remove the debt service and then remove of that any sponsor fees and expenses, which there would be asset management fee, for instance. The next definition that is important is the loan to value. Is going to be I shouldn't have put the percent here. It's the loan proceeds divided by the purchase price as a percentage. Next, we have the DSCR, which is the debt service coverage ratio, which is an important factor that is used particularly by agency to size a loan. And we'll talk a little more about that in a second. But the definition of the debt service coverage ratio is the NOI, net operating income, divided by the debt service. And that, yeah, like I wrote, it's for Fannie and Freddie. And the last concept is the debt yield, which is the NOI divided by the loan amount. And that's applicable for bridge debt. Just a few definitions and concepts. But now when you're going to talk to your lender, those are all the information that you need to obtain from them. And I made anything in blue, it pertains more, generally more to bridge debt. And the black is either applies to both or more specifically, let me read a little bit. No, actually, everything in black is more agency. Right? Though, yeah. So when you obtain a quote from a lender, you're going to ask for the interest rate. So interest rate can be a fixed interest rate, can be a variable interest rate. If it's a variable rate, the lender may expect you to buy what is called a rate cap that is going to limit the variation of the variable rate. So you need to understand what's the rate cap rate, what's the length of it, for how many months, years, and what's the cost of it. And also, when there's a variable rate, you want to ask what's the reference rate used and the spread. In other words, it's interesting to know because there are so many nuances of particularly the SOFR, which is the overnight interest rate. But there's the 30-day SOFR, there's like the daily, there's three or four nuances, and sometimes some lenders use one, some other they use another one. And so you need to know the spread, which is what the amount the bank will add to the base rate, such as the SOFR. And so you can have an idea if the SOFR, the overnight rate forecast, you'll be able with the forecast on the SOFR, if you add the spread, you'll have an idea of what your interest rate will look like. So next piece of information you're going to want to understand is what's the loan to value that we discussed earlier in the prior slides, or more specifically for bridge debt, the loan to cost. Because in the case of the bridge debt, you're going to be able to finance the repairs as well, the capex, either all of it or part of it. And in that case, you're going to do the loan to value, the amount that will be lent to you. You will compare that to not only the purchase price, but the purchase price plus the capex. That's what loan to cost means. So next, you want to know, again, we discussed that in a prior slide, what's the debt service coverage ratio or debt yield if it's a bridge debt. You want to understand, so in some cases, I believe that agency will finance some capex, potentially closing costs, but typically it's more applicable to bridge debt. So I really should have put this in the blue color. Then you want to understand what is called, and I know it's confusing, it's called the term. So like when the balloon payment is due, it could be 5, 10, 5, 7, 10 years. For bridge debt, typically it's 3 years plus two extensions of 1 year. And here it's important to make sure that your whole period aligns with the term of the loan, right? So if you plan 5-year hold, maybe you want to consider either a 5-year term loan or maybe a 7-year, just to have a little bit of flexibility on the exit, for instance, but maybe not a 10-year. Though, when the interest rates were very low, that was the best deal to do, actually. It was the best move was to do the longest term possible because the interest rates were so low, and the chances are or were that they wouldn't go any lower. And now, if you can assume a loan in the 3%, that's it's a dream. Next, you want to know how long is there a period of interest only? That will help you to take care of some renovations and maybe higher vacancy, things of that nature. Then the amortization, obviously, if you have interest only, it doesn't apply, but otherwise, the amortization is depending if it's 25, 30 years, 35 for HUD loans, but that's the period of time during which you're going to pay principal and interest. And there's a formula that applies, but you're going to pay a little bit less of the principal at the beginning, and progressively you'll pay, when you pay down the principal, you'll pay less and less interest. So the next question that is very important to know, to understand, is it recourse debt or not? I touched on that earlier. Recourse means the people signing the loan are on the hook to repay it. Non-recourse, it's only backed by the asset itself. So if you're going to look for somebody to sign the loan on you, and some topic coming up in a second, that's a difference that may be important for them to and decide to join as a key principal or not. So meaning that non-recourse, they will be more inclined to join the deal. Next, you need to understand the prepayment penalty, if any. I think bridge is going to be predefined and fixed. But for agency, it's going to be yield maintenance, which is, in a nutshell, is going to, if you pay earlier than the term, they're going to ask you basically to pay the difference between the interest rate that they would have collected, or the interests in general that they would have collected compared to the treasuries. That's what yield maintenance is, meaning that if you buy a 10-year loan now, but you exit year 3, now they're going to want to collect 7 years worth of interests on you. And if the treasuries are really, if the difference between the interest rate and the treasuries is big, there's going to be a lot of money. If the treasuries are high, it's going to be much, much less money. But then something to think about, like the variable interest rate, you don't necessarily know where it's going to go in the future, right? It's the same thing for the treasuries. You don't know where they will be in the future. So it becomes very difficult when you deal with variable rate in general, meaning that without a cap, or the yield maintenance is very difficult to underwrite properly. So that's why typically, if we're going to do permanent debt or agency debt, it's kind of a synonym, we're going to look for some kind of step down. And here I put an example. So over a 5-year loan, it could be a 5, 4, 3, 2, 1 step down, meaning that if you exit year 1, you're going to pay a prepayment penalty of 5% of the balance on the loan. Year 2 would be 4%, 3%, 2%, 1%. Then you want to know about what's the application fee. So typically for agency, it's $15,000. For a bridge debt, could be up to $60,000. You want to know any origination fee, exit fee, extension fee. You want to know also if there's an expectation of the lender to have some replacement reserves in your budget, and if there is any escrow requirement for principal, interest, tax, insurance. I know during COVID there was a lot of principal and interest. More recently, I think it could be 6 to 12 months worth of taxes and insurance, kind of case by case. I think I'll touch on any question later on if you don't mind. So Fannie and Freddie GP or KP requirements, or meaning like the people signing the loan. Actually, yeah, there's a little more than that. But so the basic requirement from a property standpoint, 90% occupancy over 90 days. And in order to qualify for the non-recourse financing of Freddie and Fannie, or Fannie and Freddie, you need to have a net worth that is greater than the loan amount, and that's of the people signing the loan. You need to have a liquidity that is greater than 10% of the loan amount for all the people selling the loan. And also, you want to have for all the people together 3 to 5 Fannie or Freddie transactions. So that's the third requirement, general requirement. Kind of a little more, some examples of terms or general, terms, I would say, like for Fannie and Freddie. Again, they will basically land on cash flowing assets. They will look at the T12 and the rental trailing 12 months. The interest rate is based on the 10-year treasury plus a spread. They will loan maximum 75 to 80% loan to value. Yeah, at some point it was lower. It's a little bit dated, this slide, but I think it came back to the higher 70 to 75%. It's NOI constrained, and really the constraint comes from the DSCR. So it's going to the debt service coverage ratio. As we discussed earlier, it means that you divide the debt, no, you divide the NOI divided by the debt service, right? The monthly payment in principal interest. It must be at least 1.2, more often 1.25, that ratio. And depending on the market, it could be up to 1.4. So here, no, yeah, no ring of rehab. So usually there will be no financing of the capex cost, 30 years amortization, and as I mentioned earlier, either a yield maintenance and or the step down. Step down can cost between 0.85 to 0.95% higher interest rate. Some general terms for bridge.
Something to just point out, like DSCR might be a little bit different from market to market, from a large market to a medium market. So the riskier market, there'll be a difference in the DSCR requirement. So it's not, a lot of these calculations are made with a 1.25 DSCR. That's like the ideal expectation on all these guesstimations. But once you get your feedback from your lender, they'll have more specific number to throw in the calculations for what they expect a DSCR to be in that market.
Yep. Almost done. I cannot believe that time went by so quickly. Bridge could be very large loans, higher interest rates. I don't know if we didn't have the interest rate here, but these days it's about 6, 7%. A real bridge on a more distressed asset, very quickly you're going to hit the 9, 10% for sure. They will do 75% loan to value on the purchase of the asset, and they will finance your rehab or capex budget between 75 and 100% of it. And what you're going to do is to do draws. So you're going to front the money to do some renovations and then send the request for a draw to the lender. So they will send back that money to you, and you will use that as rotating funds to first do the repairs, then get the budget back. So the terms plus one, we discussed 30 years amortization. That's silly. Actually, it shouldn't be there because it's only interest only. Fees 1% in, 1% out, and each extension is going to be another percent. High application and legal fees. That's very important. Similarly, they want to see net worth, liquidity, experience, capex budget, and pro forma. So finally, the banks, like I mentioned, national, regional credit unions, they like to work with existing clients. They've been pretty cautious, though it's relaxing. They want to do business locally. Depending on the conditions, they could have attractive interest rates. Everything else is going to be similar, like the loan to cost or loan to value. The term, sometimes interest only. Amortization a little bit shorter, 20, 25 years. But no prepayment penalty. It's like some on a house actually. Less fees. But the people signing the loan, they will be personally liable. And that's all I have for you.
So the prepayment portion that segues into Arita's question, do we need to repay entire loans at the end of the term, say 5 years, you plan to sell the property or prepayment penalty.
Oh, you have the prepayment penalty. So number one, you're going to pay back the principal. That's the number one. So you have to repay the loan. And on top of that, there will be an additional fee, which is the prepayment penalty. I hope it clarifies. Bye, Brandon.
Does that answer your questions, Harita?
Philippe, can you go over again when you talked about the capital stack with the preferred equity versus the common equity? For me, as an LP investor, can you go over how you look at potential deals to invest in when they have a certain percentage preferred equity?
Yeah. Again, but yeah, let me use the simplified slide here. So because if there is preferred equity, because if you invest as part of the common equity, so like the typical investor, and let's say like the preferred equity, it's either it could be a subset of the investors, like some sponsors do that, or they really go to a third party to finance preferred equity. But in any case, if you look at common equity compared to preferred equity, you have to think about the stack. The first to be paid is whomever is at the bottom of the stack. So first, the senior debt. Second, in this illustration, mezzanine debt. Third, preferred equity. And fourth, common equity. And what I was saying earlier is if you have a big chunk of the equity is preferred equity, and I've seen some deals done like that. Now you have a very tiny bit of common equity that is on top of senior debt. Then you have the preferred equity, and then you have a tiny bit of common equity. If anything goes wrong, you have to remember you're going to be paid last as common equity. So that's the risk. And that's when I see deals with 60, 70, 80% of preferred equity compared to the common equity, I don't think it's a good idea to invest because the risk is too high in that case. Does that make sense, Carl?
Yes, it does. Thank you.
You're welcome.
All right. I think that wraps up today's presentation. Again, thank you everybody for stopping by. We're here every Thursday. If you have any recommendations on topics of discussion, please feel free to reach out. Or you have our emails, I believe. There's that QR code at the end, but
yeah, let me
always happy to help
yeah.
any way we can. And again, thank you for taking time hanging out with us, and we'll see you next Thursday.
Thank you, everyone. Thank you for being with us. See you next Thursday. Bye, everyone.
Thanks.
Thank you.